So I'm back with another reaction video. This time around, it's a short snippet of an hour-long interview between Thomas and William. So for those of you who don't know, I think William is the author of Richer, Wiser and Happier. I think it was a great book. So just a quick shout out to him. And I think this podcast is extremely interesting because there was one topic where they essentially talked about the Alibaba investment, and more specifically investing into China, and when the Chinese government is being involved in this entire investment, both bull and bear thesis. So for those of you who don't know Thomas, I actually did a little bit of a CSI or some sort of digging. I personally don't follow him, but when I go onto DataRoma, he actually runs a $8.2 billion portfolio. So he's probably not someone new. It's just my lack of knowledge to not know him, but I would presume that he's a pretty big hedge fund manager. And if I were to look at the activities of him buying and selling, he actually did own Alibaba for quite some time. So if you to take a look, I think if I'll just do a Control F here and find BABA, you can see he first entered the position in Q1 of 2021. The last time he held the position was in Q2 of 2022. So this is around 6 quarters or so. So if you to just extrapolate it out, you can kind of guess that he definitely sold it at a loss. So Q1 of 2021. So if you look back, Q1 of 2021, let's assume that he kind of caught the bottom of that period. Q1 of 2021 was around, I think it's around $220, give or take. And when he sold it out at Q2 of 2022, that's around June. The June period, I don't know, it's probably near 100. Yeah, near 100, give or take. So I think he kind of took probably a 50 to 55% loss, assuming that he didn't continue averaging down. So yeah, I think it's interesting because at the end of the day, there are many lessons being learned here, specifically comparing someone that cut loss much earlier on and compared to someone like me who back held and continue averaging down. So I'm not saying which process is the right process. I'm just saying that there are many different experiences for the same stock. People entered at a different price, people exited at a different price, and more importantly, people like me that are still in the stock. So even if I'm green, or even if I broke even on the stock, so as long as I didn't sell or I didn't lock in any profits, I can't really call it a victory, because who knows, Alibaba might tank back to $60 and I'll be sitting on a 50% loss again. So fingers crossed, but let's dive right into it. And of course, before we begin, remember to scroll down to the video and tap this cute little like button. I actually tapped onto it, but I just wanted to do a demonstration, so I unlike and I like it again. So just remember to click on the like button, and let's get right into the interview itself.
Well, with Alibaba, Tom, which I mean, I probably should have disclosed before. I own Berkshire, which I intend to own for many years, but I also have a small position in Alibaba, which continues to get smaller because it's been cut in half. And a couple of a couple of our listeners who we had lots of people send questions over Twitter. A couple of people. One is called Matt Cummins, and who said, if a stock price gets cut in half, what's Tom's criteria for when to buy more and possibly double the position in that scenario? And a guy called Chill Daily said, how do you know when to sell a position? And I was thinking with something like Alibaba, where clearly you and I and Charlie Munger and many smarter people than me have been wrong so far. How do you decide whether to cash out, whether you were just wrong, whether China's too risky, or whether to stick to the position or add to it?
Well, it's been from almost the first day. Ant Financial was the catalyst that caused the drop initially that we were able to put a small position on at the same time in Alibaba. That was a fairly substantial reorientation of a financial service venture that Alibaba profited mightily from, and it promised to have far less profits for them ever since really we entered the investment. But it was that direction was suggested, but it wasn't sure, and it's become more clear and sure over the holding period, which is
I think I'd just like to comment a little bit here. I think it's relatively true, whatever Thomas just said. There is clearly a fundamental shift in terms of the profitability, the economics of the entire business itself. But I think just to really reflect back and to understand what Ant Financials was doing back then, They were really undergoing some really risky and really shady business by being that middleman. So essentially, they just outsource the risk to all the state-owned banks or the national banks that are the other part of the stakeholders. And then they just bring in all these new consumers and whoever that wants to loan for whatever purposes. And this entire business model, in and of itself, it's pretty unsustainable. So if you to reflect back and to really compare based on that expectation, I think that's a little bit unfair. And just some context, this video was uploaded on the September of 2022. So presuming that he has probably already sold his Alibaba position. And this is based on the context or subsequently his comments will be based on the idea that he has already exited or in this case, cut loss.
About a year and a half, I guess, for us. It's quite possible, it's our belief, that the valuation has come down along with the share price. And so, and the certainty with which we believe some of the businesses would grow and contribute has raised. And so, for example, a big example of that is the cloud business. And the politicization of the cloud business, I gather from one of my colleagues that the TikTok I think it's the case that they had been a user of their cloud, Alibaba's cloud business, but would not be allowed to going forward for a variety of reasons. And then more recently, the dual listing question, the Hong Kong listing versus the requirement of changed accountings.
I think before we proceed on with this entire dual listing, because it's two different topics, let's first go back to the part where he was talking about fundamentals are clearly changing. So I think when reflecting back in this entire journey, when we see how Alibaba's revenue growth essentially fell off a cliff, I think was from at least 20% at the peak of the crackdown until even 0%. When I think back in 2022. So in 2021, I think they did around 19%. In 2022, it collapsed to around sub 5%, so 0 to 5%. On top of that, you layer in margins. I think margins was also falling precipitously from at least 15 to 20% down to just single digit percentage points of their profit margin. So when you layer all these things together, even somebody without a finance knowledge, when he look at numbers, he see that numbers are going onto a downtrend. Anyone would know that the fundamentals are clearly affected. But I think the more important part that we have to focus here is really whatever that's transpiring around Alibaba. So of course, China is going to post out great numbers saying that, the COVID lockdowns were a small issue. The GDP growth rate was still strong, I think holding at around 3 to 4%. And hey, don't worry guys, but then when you cross-refer to many of the other peers in that industry, Tencent was also suffering badly. I think right now, there are a few headwinds around Alibaba. The firstly, it's of course around macro. But I think secondly, when we look at competition like JD and Pinduoduo, I think personally, when you extrapolate out the figures, they haven't been faring very well. But of course, they're still growing top line decently because it's a low base effect. But I think more importantly, the third point that I want to point out is really TikTok, or in this case, ByteDance, really sucking up all the market share. And as I think I've mentioned it in multiple videos that I'm not worried about JD, Pinduoduo, or the macro issues because personally, in my own assessment, I think that Alibaba has built a strong enough economic moat. But instead, I should be more worried about this new player in town. ByteDance is essentially a disruptor compared to JD and Pinduoduo. And I think one more important thing when he talked about like slowing in growth in terms of cloud computing and stuff like that. So rather than just blaming macro, I'm saying that the China's economy is slowing down. One important thing is also, let's not forget, I think the tech crackdown didn't just affect Alibaba or Tencent. It affected the entire industry. And most of these industry players are also consumers of Ali Cloud, of Tencent Cloud. And when everybody's affected together, of course, top line revenue growth is going to drop from 40% to like, I don't know, 3%, 5%, 10%. And I think that is when you see the entire thing as a picture, rather than seeing it in isolated, siloed views. So at least that's my take on the entire slowdown and how things has been transpiring thus far. And the black box, or at least in this case, the black swan here, is really ByteDance.
That last one is what gave me the sense of Warren's comment, which is you don't get extra points for degrees of difficulty. And the degrees of difficulty that have surfaced by watching the Chinese government treat capital across a host of different areas, whether it's educational testing, whether it's the casino business, whether at the board level, whether it's the way that the financial service business has been treated. There's so many areas, and lastly, the cloud business with its intrusions. There's just so many areas that define complexity. That I realized that we probably took on more need to know decisions that we have to make every day we hold the shares than I realized at the start. And I would say in part because the situation worsened over the course of the holding period. It's a far more complicated investment. We'll know next week, by the way, how it's faring operationally. I think they report on the 4th. But
when you look, Tom,
I actually do agree with Tom here on this idea of you don't get rewarded for increasing complexity. The stock market is a very interesting battlefield. You get to pick your own battles. If you think that it's too complicated or too complex for you, I think you can just stay out. But I'd just like to caution, because when Thomas was framing this entire discussion, he was just talking about the dual listing between Hong Kong and the US and what are the implications or complications going forth. The funny thing is, if you really think about it, if there are no such complications, or if there's no such fear around the stock itself or the company, or in this case even the government, why do you think you have an opportunity to buy such an incredible business, such an incredible compounder, 1-point-something billion users, with the vast majority of people or businesses relying on this ecosystem to survive and to thrive? Why are they trading at such a dirt cheap valuation if you don't have such fears? So I think it's a little bit counterintuitive in a way where you want a business that is trading at a cheap enough valuation, yet at the same time you don't want such a complex problem, or you just want to sit on the sidelines and just ride on it. I think that's a little bit too much of an ask. I'm not saying that it's not possible. I'm not saying that such an opportunity wouldn't arise. But I think when such an opportunity actually do land in front of me, which is this entire China tech crackdown episode, I'm pouncing on it, and I have pounced on it, and I have been averaging down. But of course, some people might not be comfortable, and I've been receiving this comment. I've forgotten what was his name, about what? Why would you invest in a country that kills people and I don't know, commits genocide and do like human organ harvesting? I think those are very interesting comments, but on the same note, when I invest in the US, I don't think they're angels as well. So let's keep this kind of unproductive discussions on the sides. But I think circling back to this idea of complexity, sure, you can probably find less complex topics, because I would believe that by talking about geopolitics, understanding the Chinese government, how they're going to crack down, those are extremely complex topics. But to find a high quality compounder trading at such a crazy valuation, it's probably a first time. So that's just my 2 cents on
it. At China and the increasing risk, presumably, that China invades Taiwan, the increasing regulatory risk.
Or that we invade Taiwan with the current situation of the day. But go on. Yes.
Well, I mean, increasing risks geopolitically. Increasing conflict between the US and China, all of these human rights issues. Someone wrote to me last week and said to me, it's kind of a moral issue. You just shouldn't be invested in China. Like it doesn't mean you can't make money, but why put your money there? And I sort of initially sort of dismissed it, and then I was looking at it and I was like, actually, it's quite possible that he's right. Like maybe, why do I need the complication? Why do I need the headache? Why should I be supporting the persecution of Uyghurs, Tibetans?
I think I'd just like to point out here, both of them are probably from the United States. I don't think the US is also angels, as they like to claim, based on many of the moral right issues that they're talking about. I'm not going to comment too much because it will become political. And yet at the same time, even my own country, I wouldn't say that we are necessarily angels. So at the end of the day, if you're going to mix many of these things together, I'm not too sure how you're going to craft your own investment framework. But personally for me, I pretty much leave these things at the doorstep. If not, it will make the entire process too complicated. And in this case, like they said, you're not rewarded for complexity.
Yeah, it's a horrible thing.
What do you think? How do you play this out in your own mind?
Well, it's just one of those things that I just said. Warren, as so often is the case, he has given us the answer. And that is, you get no extra credit for degrees of difficulty in investing. So, for example, we have a position in Google. Google has one of the absolute most fabulous cloud businesses. And I've held this position, ongoing position in a small position versus a 4 or 5 times larger position in Google. But I've held the small position in part because of the possibility that Baba would get us into the Chinese cloud business. But it's not clear. That's become politicized as well just recently because of this TikTok move by the government. And so many of the things that we're involved with seem to degrade down to a political outcome, and those political outcomes seem to break largely in the favor of the domestic participants. In which case, I go back to what Warren said: is you don't get any extra credit points for degrees of difficulty, and indeed, we can take advantage of that insight and keep our capital and find something else that's more promising, and we're prepared to do that. So
more broadly, when you think about these issues of morality and investing,
yes,
it's complex. And I'm not trying to be judgmental or moralistic about it. I worry about this stuff a lot myself. But obviously, you own Philip Morris; it's a big position. You own Heineken, and Pernod Ricard, Brown-Forman. These.
So I think if you're interested in the interview specifically, please feel free to check it out. I think it's a 2-hour long episode. He then go on to talk about how he invests in like cigar companies and I think alcohol companies that might be a little bit tricky in terms of trying to square away your moral standing. So I think I just wanted to end off the discussion with this. I know specifically when you talk about many of these Chinese tech companies, this entire political narrative will always be swept in, saying that, oh, the Chinese government is crazy, the amount of regulations they introduce is incorrigible, China is uninvestable and stuff like that. Let's not forget that there are thousands of other stocks or companies, real companies behind them that are listed in the China exchange, whether it's the Shanghai or the Shenzhen exchange. And you don't see fund managers talking about, oh, how the Chinese government is going to do this and the difference between the US-China tension, etc. I think it just happens that a lot of these tech companies are also listed on the US exchange, and many of the international investors only have access to many of these ADRs, which is the American Depository Shares. So you don't see many other Chinese investors that talk about Moutai, saying that how the Chinese government is going to crack down on the liquor company because they're scared that, hey, the population might be drinking too much liquor or too much alcohol. They want to control the alcohol consumption. Just let that sink in for a little. Nobody's going to talk about, Li-Ning, which is a sports brand, the China equivalent of Nike, talk about, people are spending too much money on sportswear and sportswear are charging astronomical amount of money. So let's just try to ban sportswear. And if I'm not wrong, you actually go and just check out many of these consumer staples brands in China. They're trading at high 20, high 30 PEs. Means that the market is extremely euphoric. They're assigning a huge amount of multiple to them. And they're saying that these companies are worth buying. But yet at the same time, when you reflect back, when you look at it from an outsider or an international perspective, many say that, Alibaba or Tencent is uninvestable. So just think about it for a moment. Why is there such an interesting perspective? So with that, I'll see you in the next video. But more importantly, I will see you on the moon. Goodbye.